Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 125. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, sadly, we've got a lot. Once again, it appears all change. So let's start off with the UK and its never-ending political crises. So Keir Starmer resigned. We are currently in limbo while we await internal Labour Party dynamics, which seems set to appoint Andy Burnham as the next Prime Minister in a left-wing coup. So that will make Andy Burnham the 7th Prime Minister in 10 years. So Andy Burnham is reported to be intending to remove Rachel Reeves as Chancellor, hurrah, but then appoint possibly Ed Miliband.
I
Go on.
don't think he will, Keith, because is it Unite and one of the other Unison have come out against Ed Miliband, saying that he's a disaster for jobs.
Yes.
He's obsessed with net zero. So I think Burnham will not do that.
Yeah. Well, we hope so. When Unite think he's too left wing, then. Anyway, so we very much hope Ed Miliband won't come in as Chancellor. The gilts market took the change in Premiership with total indifference, which was reassuring. Now, what is Andy Burnham's likely economic agenda? Well, number one, regional devolution. You may have seen in this morning's FT, he's talking about moving part of the government to Manchester. The civil servants were sceptical. Interventionist industrial policy, including state support for key sectors, very left-wing. Infrastructure-led growth, i.e. more spending, more gilt issuance to fund investment. Renationalisation of essential services. How's he going to afford that?
So I think renationalisation of essential services, effectively the railway network is in the process of being renationalised.
Yeah.
So rightly so. Thames Water, which is a complete disgrace and abject failure. I mean, basically, it should have been allowed to go bust many years ago by the Conservatives, and all he needs to do is allow it to go bust. And it's been incredibly badly run by the private sector, but particularly the financiers in the private sector, who have ripped out vast sums of money from it and ended up giving it an unserviceable debt burden. Well, they need to pay the price. It's market economics. And the fact that it's never been allowed to go bust has enabled, it's moral hazard, they call it, isn't it? Where basically people are protected from their bad decisions.
Well, I totally agree with you, Richard. It's been allowed to be run incredibly badly.
Yeah.
The thing is, if the regulator had imposed its own conditions and imposed those costs on a badly run company, and if it couldn't actually execute running the Thames Water as it should have been, it should have gone bust. But they propped it up to socialise the debts, essentially.
Yeah, it was completely the wrong thing to do. It's clearly politically led by the Conservatives, but completely the wrong thing to do.
Shift to wealth and property taxes instead of income taxes. Now, as somebody who owns a large house, I would actually welcome a shift to property taxes if you were to properly reform all property taxes, including stamp duty and council tax. Just adding further property taxes would be a disaster. You have to get stamp duty is the worst tax in the UK, as far as I'm concerned. It essentially stops people from moving and is an unfair tax on the young who want to buy a house and in favour of the old who barely move. So
move even less rarely now.
Exactly. What you want to do is encourage old people who have like 5-bedroom house with all their kids have left home to move into a smaller house. Efficient allocation of property within the country. As it is, you actively discourage them from doing so. He may be more fiscally conservative than certainly I fear. Let's hope that's true.
Mm, yeah.
Okay, and on to news in the rest of the world. Well, last time in the weekly, we were talking about how we're expecting Iran to have to close the straits, oil prices to go to the moon. None of that happened because essentially Donald Trump capitulated. Iran did not need to close the Straits of Hormuz to get what it wanted. Donald Trump signed a memorandum of understanding with the Iranians saying that the straits remaining closed risked a depression and an economic catastrophe, and basically gave in on pretty much all fronts. The Iranian government believes it's won the war and has strengthened its position internally and externally. A big loser is Israel. Part of the conditions of the Memorandum of Understanding is the war between Israel and Hezbollah in Lebanon. If there's no ceasefire on that front, then the Iran is threatening to close the straits again, and that effectively ties Israel's hands in Lebanon. Oil prices fell sharply. We'll take you through all the data, and that is very good for consumers and businesses in the West and for the inflation outlook. The US Senate has subsequently passed a bill which demands Trump halt the war and seek Senate approval for further military action, thereby tying his hands in the ongoing negotiations. The market thinks that it's all over, but I'm not so sure. We'll go through more on that in a bit. The Fed met and held rates at 3.5 to 3.75% in Kevin Warsh's first FOMC meeting. He vowed to fix 5 years of misses on inflation. That's good news. So he had a very hawkish statement. He ceased to provide forward guidance, and the dot plot is hawkish, showing that FOMC members were expecting to raise rates 2 times in the coming year. Equities, short-term bonds, and precious metals all fell after the FOMC meeting. Long-term bonds rose as inflation expectations fell. The Bank of England met and held rates at 3.75%. As we've been expecting, the market had been expecting the Bank of England to raise rates in the coming year. Just can't see that happening now with oil prices coming down. The US government separately forced Anthropic to deny foreigners access to its most advanced models, Fable and Mythos. Finally, Cuba passed a package of economic reforms in an attempt to appease the US and ease rules on foreign investment. Now Donald Trump doesn't have much to do. I expect him to do something about Cuba.
Well, maybe he will. Maybe he's learned his lesson. Just on the mythos and fable thing. Do you know? So it was supposed to have guardrails on it so that you couldn't use it to hack. Or you couldn't use it to hack. So you couldn't say, "Tell me what is wrong with this code," or "Tell me how I can improve, how I can find weaknesses in this code." So what Amazon engineers did was they typed in the 3-word prompt, "Fix this code," and then Mythos went through and told them everything that was wrong with it.
Excellent.
In other words, gave them the hack, and it does seem like it is probably quite powerful.
So this is the Fed dot plot, and you can see we're at 3.75, and Fed members are expecting rates to be higher on average in 26 and possibly 27. Oil prices coming down make that less likely, in my opinion. The bond markets took Kevin Warsh's comments and revised upwards their rate expectations, and the market is now pricing in 4% Fed rates, i.e. 1 increase in interest rates by the end of the year. And that is a big change from earlier in the year and shows the effect of the Iran war on inflation in the US. So this is current market expectations for US inflation, and you see that falling oil prices mean they expect inflation to come back down in the latter part of the year. I think that eases pressure on the Fed to raise rates. Okay, war news. The US and Iran signed the Memorandum of Understanding. Oil fell by about 17%, which is very bad for me. I'll tell you through the data in due course. But pause, have a read. The past 2 weeks have seen the early stages of the ceasefire were met with non-compliance by Israel and Hezbollah. Iran threatened to close the Straits and then said it did so, and Trump said no, it hadn't, etc., etc. We have had peace talks in Switzerland over the weekend, with both sides claiming progress. JD Vance said that Iran had agreed to UN supervision of the dilution of its enriched uranium. Then Iran came out and said no, it hadn't agreed to any of that. And then the IAEA came out and said yes, Iran had. So both sides appear to be lying. Very difficult to know what's going on, frankly. But
It's all part of their negotiating position, isn't it, Keith? To try and pressurise the other side, but when
yeah,
you're on the outside, it just appears to be completely chaotic.
absolutely. But the market thinks it's all over. Now, let's quickly go through the Memorandum of Understanding. So, number one, termination of conflict on all fronts, including Lebanon. That means Israel and Hezbollah both have to behave. If either of them start the war again, then everything's off, and Iran may try and close the Straits. Respect for internal sovereignty of both the US and Iran. So US has capitulated and abandoned any attempts at regime change, which was an original war aim. Ceasefire to last 60 days, but may be extended with mutual consent. Market is expecting it's all over and it will continue indefinitely. US to end its naval blockade and remove its forces from the vicinity of Iran within 30 days. Iran to make best efforts for the safe passage of commercial vessels with no charge for 60 days. Iran will negotiate with Oman and other Gulf states for future administration of the Straits. Now, that's quite an important sub-clause because the Persian Gulf Straits Authority, which is Iran's committee for managing the Straits, appears to be considering the possibility of charging ships administration and insurance fees for transiting the Gulf after that 60-day period. More on that in a bit. US and its partners to provide Iran with a $300 billion fund for reconstruction and development. Where that money is going to come from, nobody knows. Donald Trump has subsequently stated the US would not contribute to the fund.
Saudi Arabia, Qatar.
Yeah, like enemies of Iran.
The United Arab Emirates.
Having been
even Israel, you never know.
Yeah, well, fantasy. US terminates with immediate effect all sanctions on Iran. So, Iranian tankers have now rushed to leave the Gulf. They've been let go by the US and are on the way to Asian markets where they will receive full Brent price for those cargoes. It's been a huge win economically for Iran. As you'll see, most other tankers are still trapped. Iran commits not to develop nuclear weapons. Agreement on the destruction of Iran's stockpile of highly enriched uranium will be decided in subsequent negotiations, i.e., they've kicked the whole thing into the long grass for a bit. And US to unfreeze all Iranian assets and make them available to Iran with immediate effect. Full capitulation. So, pause, have a read. This is Trump's claim about the MOU and what it actually says. He has bigged up the MOU, but actually it's quite vague and a lot of things have been pushed forward. A lot of the difficult negotiations have been pushed forward to just get a fast deal to open the Straits. A lot needs to be resolved. Now, the Institute for the Study of War has examined Iranian statements, and it thinks that they believe the Memorandum of Understanding requirement that it opens the straits means that it can open them under Iranian management, and it will seek to charge tolls or insurance fees or something else for transit once the 60-day ceasefire period has ended. And this is what it's attempting to do. It's attempting to move the traffic separation schemes north into Iranian waters, where it can then regulate traffic. So this is the statement from the Persian Gulf Straits Authority, which is an Iranian organization for managing the straits. And during the 60-day period covered by the MOU, they will not charge tariffs for security, safety, and environmental services, as well as related Iranian insurances. But that clearly implies that once the 60-day period is over, they might do. And as the Senate is now attempting to tie Trump's hands against further military interventions in Iran, it's difficult to see what he could do if they decided to close the straits or charge tolls again.
I think there's some debate, Keith, as to whether it has any legal standing. And I think even the Senate is not convinced that it has legal standing. But it's a shot across his bowels and makes life harder for him.
The president can override any Senate bill that hasn't been passed with a 2/3 majority. So, he could do something, but it's proving increasingly unpopular, I think what we can say.
Yeah.
The good news is that gas prices have already started to fall. The market was right that peace negotiations, when we reported last time, peace negotiations were moving towards a conclusion. And already some LNG is getting through. Okay, so let's have a look at the latest status report from BCA Research. So currently, they think 9 million barrels remain shut in because flows through the Gulf have not resumed, but they are increasing. In the last few days, you have seen a rise in the number of oil tankers going through the Straits. We are still not back up to normal, but that is rapid progress. And the market is anticipating that we will rapidly go back to normal. Rory Johnson of Commodity Context is saying that in the last few days, oil flows are back to 10 to 15 million barrels a day, which is pretty much normal. But oil tankers are not going back through the strait, i.e. there are some escaping, but there are none going back to refuel as yet. So most of this is Iranian oil. So Iran is the big beneficiary of the initial reopening of the Straits. But as you can see from those charts, flows are not back to normal. Transit costs continue to have come down roughly. Now, the US shale patch has not reacted by massively increasing its rig count. There was a slight change, but not much. Gasoline prices are falling. Diesel prices are falling in the US, although they're still elevated. Jet fuel prices have come way down, but they're still up 40% on the year. This is Europe. Urea prices are back down to normal after, as we discussed last time, what appears to have been a buyer's strike by farmers. Agricultural prices have seen no reaction whatsoever.
That reaction will come when the harvests are smaller in the autumn.
Absolutely. So, summary, flows through Hormuz are improving rapidly but remain far below usual levels. The market is assuming they will normalize, but as we've seen, after the 60-day Memorandum of Understanding, Iran reserves the right to regulate traffic through the Straits of Hormuz. When you look at the Bab el-Mandab, flows have never recovered to normal following the Houthi attacks of 5 years ago, and expect a lingering effect. Now, a lot of the bypasses that are already have been developed or in development will mean that flows through the straits do not need to return to their previous levels for world markets to return to normal. But there will be a lingering effect. So, prognosis. The US killed Ayatollah Khamenei. When Donald Trump says that Iranian US relationships have fundamentally improved, I'm deeply skeptical. Iran thinks it's won this war and has effectively forced the US to capitulate. I worry, or I think, that Iran will seek to control the Straits, and when the market thinks flows are going to go back to normal, I don't think they will. Richard, your thoughts?
Yeah, it's very difficult to tell, isn't it? So I think here, listening today to a guy who was saying that Oman is going to rapidly build out its pipeline from 1.8 to 3.5 million barrels a day. That obviously there are a lot of loaded tankers that are now leaving the Straits, and as you say, are there empty tankers going in to refill? That'll be a real indicator that oil is actually flowing as opposed to just exiting and in a one-off. I don't know whether there are any tankers preparing to go, empty tankers preparing to go into load up. I think everybody was surprised by the size of the inventories, actually, and the fact that the disruption to the flow didn't occur, disruption to prices didn't occur as was expected. But I also think that the inventories were going to run out at sometime in July, or the ability to control prices were going to run out sometime in July. And therefore, Trump had to reach this agreement with the Iranians. And I mean, from Iran's, Iran will never get a guarantee that Americans are going to do this again or Israel's are going to do this again. And so it's, Iran is dealing with, from its point of view, it's dealing with an untrustworthy counterparty. And so you would expect it to take all precautions that it can.
Well, I think Iran has been strengthened internally and externally, and it believes Trump's negotiation position has been weakened. I think it has. So if I was Iran, I would absolutely be attempting to assert my control of the Straits, and I just don't think flows through the Straits are ever going to go back to normal.
No, I doubt it. I agree with you.
There will be increased costs and increased uncertainty.
There's also the significant damage that is going to take quite a long time to repair that's occurred to port facilities and refineries and so forth, storage facilities. That is not going to be fixed overnight.
Yeah.
There's the issue of whether the wells can be reopened, and if so, what their productivity is going to be. All those questions have yet to be answered. So we shall see. But I think that it's too early to prognosticate with any degree of certainty.
Yeah. Okay, on to economic news. Well, the Bank of England met and kept rates at 3.75%. Falling oil prices should now allow the Bank of England to avoid raising rates in the coming year, is my expectations. UK inflation came in below expectations in May. Hurrah! 0.2% month on month, 2.8% year on year, core at 2.6%. So there is little sign of secondary inflation effects from the Iran war. That's good news. UK earnings, excluding bonuses, continued to fall to 3.4% year on year, but including bonuses, they rose to 4.4%. In either case, given piss poor UK productivity, wage growth is still too high to be compatible with the 2% target. Employment change in the 3 months to April was, according to the Labour Force survey, a positive plus 100,000. But according to HMRC payrolls, it was minus 78,000 and the claimant count is rising. So once again, UK statistics are a total mess. The key point is the Bank of England believes the labour market is weakening. So they appear to believe the HMRC payrolls, not the labour force survey. The PSBR missed expectations in May. Expect more tax rises from Andy Burnham. In the EU, not much data. Industrial production plus 0.3% year on year in April. Construction output plus 0.9% year on year in April. Not a very dynamic economy. In the US, Fed Met kept rates steady at 3.75 as previously discussed. Within the last hour, we have had PCE inflation in May, which came in slightly better than expected at plus 0.4% month on month. Note that is much higher than in the UK. 4.1% year on year, again high, core 3.4%. So Kevin Walsh is quite right to say that over the past 5 years, the US has consistently missed its inflation target and he needs to get inflation expectations down. But the rest of the US economy is doing very well. So May retail sales were red hot. They came in at 0.9% month on month, 6.9% year on year. And as you see when we go through the data, the nowcast, etc., all absolutely fine. Right, so market news. Well, last time we were saying how SpaceX shares were a total joke. Well, they rose 30% on debut. So once again, that shows how little we know. But since then, they've fallen sharply and are now below the IPO price. OpenAI financials have been leaked, and in 2025, they had 13.1 billion in revenues, an operating loss of 20.9 billion, and total losses of 38.5 billion. And they want to go public for 850 billion. Iraq is threatening to leave OPEC unless its quota is significantly increased. Essentially, everyone's going to be trying to pump like mad at the end of this, which is very bad potentially for oil prices if the Straits of Hormuz reopen. But then on the flip side, we have lost over 1 billion barrels from inventory and everyone will be attempting to restock. And if I was emerging markets in Asia, I would be attempting to over restock and increase my strategic reserves. So equities were mixed. So we had lower oil prices but higher interest rate expectations. Net, the FTSE All Share was up 2.1% over the past couple of weeks. S&P 500 down 0.5%, Nasdaq down 1.3%, Russell 2000 up 2.3%, Hang Seng down 6.4%. More on that in a bit. Energy commodities fell hard, super bad for me. Brent down 17, UK natural gas down 19.4, but very good for UK inflation. Industrial commodities also fell hard. Aluminium down 11%, copper down 6, lithium down 8, nickel down 5.4. Precious metals also fell hard due to higher interest rate expectations. Gold down 4.5, silver down 14, platinum down 8, palladium down 8. Some charts relating to markets. Well, this is SK Hynix, and Korean equities have had a very volatile couple of weeks as markets have begun to worry about the full valuations of chip makers. This is Micron shares, and they fell sharply when Korean markets fell 10%, but have since recovered. Were on very strong earnings. These are the earnings. Amazing. So markets are currently torn between concerns over very high valuations and incredibly strong earnings. Much more on this in due course. I thought this was interesting. So the carry trade is back on. People are borrowing in yen to go and fund their positions elsewhere, despite the rising Japanese long bond yields. If you borrow short in Japan, Japanese short-term rates are still very low. And on to equities, Richard.
Thank you, Keith. So all the markets pretty much still up for the year. Bit of a mixed week. FTSE All World unchanged. FTSE All Share up 2.1. Stocks Europe up 2.9. S&P down 0.5. Russell 2000 up 2.3, Nasdaq down 1.3, Hang Seng down 6.4. The only one that year to date is negative at 10%. The topics up 3.2. Bitcoin bad, another bad week really for Bitcoin, down 3%, down 31% for the year. the pound and the euro against the dollar, basically they're down against the dollar. Dollar index is going up, and it's up 3.6% for the year. And contrary to all the doomsayers' expectations that the US dollar was toast, the US dollar is actually quite strong at the moment.
Yeah.
And the VIX was down nearly 7% and up a mere 20% for the year. This is the FTSE All World Equity Index.
Yeah. Gone nowhere in the last couple of months, basically, torn two ways.
The FTSE All Share, which has basically been almost flat since the start of the year.
It has, yeah.
The Euro Stock 600.
Yeah, the Euro Stock's a very good example of why markets are different from the economy, because the European economy is going nowhere.
Yeah, completely. S&P 500, NASDAQ coming off the boil a little bit.
Yeah, last time I said we're in a topping formation. I stick to that, actually.
Maybe I'll be right. Keith, Russell 2000.
Now, I listened to a very interesting podcast during the week by Jeremy Grantham, the legendary investor, and as he put it, perma bear. And he was talking about, so he's got a new book out talking about the biggest crashes in history. And he was talking about the 1929 crash. And one of the big indicators the market was topping. And that was the leaders started to underperform while the rest of the market kept on rising for 6 months. And when you look at the NASDAQ, is that starting to happen?
The demise of the NASDAQ has been called for many times and for a long time, including by us.
Yeah, mainly by me. Who gets everything bloody wrong.
So the Hang Seng basically has taken a nosedive, and weak Chinese retail sales, highest US dollar, Chinese property investment down 60% year to date, and higher interest rates. So fixed asset investment down 4% year on year. So basically, a lot of headwinds for the Hang Seng.
Yeah, interesting.
The topics is just a straight line. It looks like it's being managed, doesn't it?
It does. Straight line up.
So this, can you see that? This is the chart of MicroStrategy. Weekly chart of MicroStrategy. So actually, I seem to have chopped off the dates, but the this point here, where it starts its run up, is 2024. So it's gone all the way back down to where it was in 2024.
Yeah. Well, frankly, I think it goes to zero.
I couldn't resist putting a little face in there. my charting technique.
That's proper technical analysis.
Pound against the dollar, still within the range, but at the bottom end of the range it's been for some time now. The euro against the dollar looks like it might have popped out of the bottom of that range, certainly in the duration of this chart, which is interesting. Dollar index, definitely quite strong at the moment.
Yeah, now when we talk about commodities, etc., most of them are priced in dollars. So that exaggerates the falls.
Yeah, I don't particularly buy that commodities are down because the dollar is up, actually, because the movement in commodities is much, much bigger than the movement.
It is true. Yeah, absolutely.
It sounds like a spurious correlation stroke explanation to me. There's
so, Richard, when we talk about, say, gold, which has been part of the debasement trade, when Kevin Walsh talks about raising interest rates, that is hard currency talk, which undermines the attractiveness of gold, for example.
Yeah. Maybe.
Okay.
So there's the VIX, which is heading back down towards its lows, having spiked up in early June.
Still astonishingly low.
Yeah. Goes with Keith's point, the Mag 7 has started to underperform the rest of the S&P, having been a great outperformer.
Yeah, this is Jeremy Grantham's point.
Yeah. So normally the equal weighted S&P 500 outperforms the market cap weighted index. And periods of underperforming tend to be mean reverting. So that implies that the main cap AIs will start to underperform in future.
Yeah.
They probably will.
Well, I think they will, but they could all fall, fall sharply.
Yeah. So there's been significant significant improvements in return on investment, and that has supported the higher PE multiples. This is a chart from 1950 to 20 to now, and you can see the big cycles in the return on equity.
Yeah. So
It's
basically,
it's at the top, isn't it? Basically, it's quite a
it
significant
is.
peak.
Yeah. And you get sharp reversals in that line. And that implies the S&P 500 will cycle down at some stage.
Analysts are expecting S&P 500 profit margins to keep rising strongly in the next couple of years. We've often commented that at some point they're going to be wrong, and they've not been wrong so far, have they?
No, they haven't. But, that's all held up by very strong AI investment, as we've discussed many times.
Yeah.
Yeah. Can that last for another 2 years? Question mark.
It's a bit like you gaslighting, it can't possibly be true, and then it's true, and it can't possibly be true, and then it's true, and you start to doubt your
Yeah, I know.
own judgment. So this is the boom built on debt. Look at the rise in the amount of debt from 1995 until now, including investment grade, high yield, and loans. Presumably, are the worst category of debt, the most likely to default category of debt. So whereas equities have remained pretty much flat in the sense of the amount raised, the amount of debt raised is huge.
So one of the things Kevin Walsh is talking about is getting rid of forward guidance.
I think that's a good idea.
I think that's a very good idea because one of the side effects of Alan Greenspan and forward guidance is to reduce the volatility and of interest rate expectations. And a side effect of that is the increase in debt. Because if you think if the outlook for interest rates is more certain, you're going to be more confident in taking on more debt. And I think if you can inject some more uncertainty into that, you will start to rein in borrowing, he says, hopefully.
It's also a pointless exercise, isn't it? It seems to me, because at that point, the central bank knows no more than the market knows. And, it's a little bit like it's making themselves, they're far too important anyway, and it's like making themselves. And he's also cut down the number of press appearances, hasn't he? Thank goodness, because it was like there was one every few days, and it's what useful information can they possibly be imparting? And the press were there like panting dogs waiting for the next nugget of information to drop from the mouths of these people, and they had anything to say. So this is token expenditure. So for AI, and so actually the aggregate expenditure on tokens. What is the aggregate expenditure on tokens?
So it's how much companies are spending on AI, basically, and it's falling. Yeah, and I think this is a very important chart, and we've got more on this coming up.
Yeah, as the utility of AI is becoming better understood. It's very useful for some things, and it's very unuseful for other things.
Well, it's everything we have been talking about relentlessly over the past year, Richard.
Yeah.
So, why pay up for the latest model when you can use the old model and it's much cheaper?
And investors have very little cash left. So extreme low levels for cash. Mind you, it's been pretty much extremely low for the last 8 years.
That's true.
With the odd little bounce, but basically has been very, very low for a long time. Margin debt is super high.
Yeah, look at the previous precedents. Really, really high.
This is a margin debt expansion versus contraction indicator. So the red line is what it's doing year on year, and the S&P. So actually, it's bounced around an awful lot, hasn't it? Whereas the S&P has been fairly determinedly higher since '09 until 25.
Well, the thing is, Richard, I wonder how much of this is just mechanical. If the market falls, the margin debt comes down,
Yeah, people get stopped out. So an average year for the SPX, you're saying this is an average year or it's not an average year?
This is an average. So this is how the S&P behaves in an average year.
Ah, okay. So basically we're saying that the S&P is going to be quiet now for the next 3 months.
Yeah.
And CBOE, the VIX index, is going to rise.
Yes. Entering the doldrums.
Mm.
Of course, in a market crash year, September, October, dangerous.
Yeah. 3 months drawdown following the new chair. So every new Fed JSC weakness in the first 90 days, the average drawdown 12%.
Yeah. That's
Are we going to see that?
Yeah.
And investor allocation to treasuries. This is a 40-year chart. I like 40-year charts because you can really see what's going on in them. And the trend is inexorably downwards.
Now, I found this really surprising, actually, because mechanically, you would have thought somebody needs to be buying all these treasuries. And allocations must have gone up because there's so many of them.
So who are investors? That's the question. Are they?
That's true.
Funds?
So if they're held by banks, etc.
Yeah, because you're quite right. Someone's going to be buying them, but presumably the category of investor excludes the big holders. Probably also excludes the Cayman Island holders.
Yeah.
Total real returns on treasuries have been very poor. It's a difficult chart to interpret, this one, isn't it?
Yeah, but the thing is, it's when you have very high allocations, as we've discussed before, Richard, the primary driver of equity returns is allocations.
Mm.
When you try and push money into equities when there is essentially no new issuance, as there hasn't been for the last few years, where's that? Who do you buy them off? You buy them off other people at higher prices. So that drives the price up.
Yeah.
And now, if nobody's buying treasuries when there's loads of issuance, then returns are going to be piss poor. And that's what we've seen. But this chart is mean reverting.
Yes. Yeah. S&P earnings growth outlook from whom? Top-down charts.
Yeah, this is Callum Thomas, and this is everything we have seen.
Yeah.
And that just looks totally ridiculous. But the market believes it.
Yeah, but AI it's a tool, isn't it? It's not going to increase earnings across the board. It's going to change the nature of the competition to maintain your earnings.
Yeah.
So equity supply poised to surge in the second half of 2026 and in 2027. This is all with all the IPOs, the AI. I wonder, is SpaceX included in this, or has that fallen out of this sort of? It's probably included, isn't it?
Well, more on that in a second, Richard.
And Nvidia needs to raise 20 billion from the bond market as its investment needs exceed its enormous cash flow.
Yeah, I thought that was interesting because it's been so profitable, but even it is now investing more than it makes.
Can't help feeling that's quite an unstable situation.
Yeah.
So the IT service company shares plunging over fears of the impact of AI, which I think we've mentioned before. Accenture's quarterly revenues fell by 2%, but the share price fell 18%, highly geared to its revenues.
Yeah. Now, the thing is, when there's a secular trend like this, it can take years for these companies to bottom, and you should not be bottom fishing against a secular trend, in my humble opinion.
Yeah, difficult to know, isn't it, how much AI is going to affect these businesses genuinely over the course of the next few years. Very uncertain, I would say.
I agree with that.
And excess liquidity is forecast to fall, which may be bad for equities and good for bonds. certainly in theory it should be bad for equities.
Yeah.
Hindenburg, we're always having Hindenburg signals. They don't really do anything, do they?
Well, we've only had them in the past couple of weeks, Richard, because they're back.
When did the last Hindenburg signal actually result in anything significant?
That's a very good question.
I'm scanning this chart and I can't see anything. I'm sorry.
Yeah. Okay. But anyway, it sounds good.
Doesn't it just? Yeah. So the US equity market, by historical terms and comparison, is expensive. Traded PE, should PE, trend PE, dividend
Yeah.
yield inverse, price to book, and forward PE, expensive in all of them.
Yeah. And this is very mean reverting. Just look at any one of these charts.
Gosh, 2026 total return to SanDisk, 800%.
Yeah.
Yeah, it's been a fantastic return for all the AI-related companies except Moderna. Even Moderna actually probably is AI-related because they use AI in it's a pharmacy, isn't it? Pharmaceutical.
Yeah.
They use AI some use AI now to look for active drugs.
Yeah. Thank you, Richard. And quickly onto SpaceX. So last week we were saying, how SpaceX was the most ridiculous fantasy. It didn't stop its shares surging almost 30% in the 2 days after IPO, making it briefly the fourth largest company in the world, above Microsoft and Amazon. But, if you're going to stag and gamble on the share price going up, then you need to get out. And I think it's down and it's unlikely to go back up, frankly. And here you can see why, because punters piled in pre-IPO, causing that surge in share price. Now, going forward, the lock-ins are not very onerous. So you've only floated 4.9% of the company. By August, some of those lock-ins start to come off and insiders can start to sell shares. By January next year, you could have 40%, i.e. 10 times the current share issuance coming on the market. In 18 months' time, you could have the whole company coming on. So you're going to have potentially a huge amount of issuance needing to be absorbed by the market. That's very bad for the share price. And reminder, I thought this was a corking chart from Charlie Bilello, and this is major IPOs the last 15 years, the return over the first year, and their maximum drawdown. Every single one of them has seen quite a large drawdown, and the average return over the coming first year is minus 31%. Frankly, companies have an advantage when they IPO, and they IPO at the best time for them, when sentiment is highest. Be very careful in IPOs. SpaceX on 112 times sales, Exxon at 1.9. I know which one I'd rather have, frankly. And on to commodities. And let's start off with the catastrophe that is energy prices for yours truly. So last time we were saying how I expected oil prices to go to the moon. Well, they didn't. The Straits reopened because Donald Trump capitulated. Super bad for me. Although actually, not too bad for my portfolio, believe it or not. So Brent was down 17%, WTI down 19%. Great news. Dutch natural gas futures down 13%, UK natural gas futures down 20%, US natural gas futures actually up 7%. Summer there means stronger air conditioning demand, power demand. Coal down 5.4%. Uranium, totally indifferent, up 0.8%, up 5% for the year. So this is Brent. I mean, when you look at this, it is discounting a lot. It's basically saying the Straits are going to open and stay open, and there's going to be a glut in the next year. I just don't think you're going to get these Straits fully reopened. This is WTI, same. Numbers specific to the oil market, you are continuing to see inventory drawdowns in the US, and it will take a while for flows from the Middle East to hit the US. And now the danger is if the US continues to do SPR releases when new supplies start to come from the Gulf, then you will have an immediate glut and oil prices could go low. But at some stage, they're going to need to refill their inventories. US crude production in the past couple of weeks, pretty stable, up 7,000 barrels a day, still down 21,000 on the year. So no supply response so far. Baker Hughes rig count up 2, up 21 for the year. And this is the Brent futures curve. Notice it now believes that Brent will not go below 70 until 2031. Now, in the past few days, Brent has got down to 73. So this whole curve seems to have shifted down a lot in the last week. Meanwhile, inventories are low, although propane inventories are very high. Gasoline, distillate, etc., all low. The IEA is forecasting that we are going to move rapidly into surplus and stocks will be rebuilt apace starting in 2027. And it thinks that you're going to have an oil glut of next year 2.5 million barrels a day. The IEA, I found this absolutely astonishing. It thinks you're going to have a surplus of up to 6 million barrels a day. I'm mystified. Where's that going to come from? That's only possible if you have a supply response due to higher oil prices, and really the high oil prices didn't go that high. And B, there's been demand destruction, and I see no evidence of that.
Yeah.
Natural gas prices coming down, hurrah. UK, hurrah. US rising a bit on seasonal demand. Now, this is US production growth forecast for natural gas, and you can see it now thinks that the US will produce more natural gas in the coming year, and its assumptions for the price of US natural gas have fallen quite sharply. So it believes that US will remain fundamentally oversupplied. Coal has come down a bit, but actually much less than you might expect. Uranium going nowhere. On to industrial metals, Richard.
Keith. So generally speaking, it was a bit of a bad week for industrial metals. Aluminium down 10%, cobalt unchanged, copper down 5%, iron ore down 1%, lithium down 8%, neodymium down up 6%, nickel down 5%, tin down 4%, and zinc down as well. I think the most noticeable thing, just popping back for a sec, is that although copper was down a chunky amount, it's still up 7% year to date.
Yes.
And aluminium, which is like fallen off a cliff, hasn't it?
Well, so the market is now expecting that the Gulf aluminium refineries will come back online. And again, the aluminium market has proved more resilient than people expected.
Yeah. Cobalt just hasn't changed. Copper has dropped back down onto its sort of recent trend line. Iron ore has fallen away back to where it was almost this time last year. Lithium perhaps consolidating a bit.
Yeah, when you look at a long-term trend line, seems like intact, frankly.
So neodymium, nickel, tin, and zinc. Precious metals. Not a great week for precious metals. Gold down 4.5% and now 7.6% year to date. Silver down 14%. Platinum down 8%. Rhodium down 2%. Palladium down 8%. So a bad week for precious metals. There's gold. And I mean, central banks are still buying 1,000 tons of gold a year, roughly.
Yeah.
I just think this is This is just a pullback after a very sharp rise.
Yeah. The trouble is, Richard, when punters have piled into so much gold, you know, if it comes down, then that could all come back out again.
It could do, yeah. Silver, which is has fallen back by roughly 50% now.
Yeah.
From that peak. I think silver is in a structural deficit. Demand for silver is going to go up, not down. I think there are a lot of large entities with large short positions that they have to clear, and that this is part of that process of them clearing it.
Yeah.
Otherwise, they'll be bankrupted.
Well, my original prognosis was right that, when you get a big rise like that, then it tends to come down afterwards,
Yeah.
and tends to overshoot to the downside, frankly, as
Yeah.
people who've held sell and buyers stand back. So, this could go substantially lower yet, but that would be a buying opportunity.
Yeah. Agreed. Platinum, rhodium, and palladium.
So this shows the potential for these precious metals if we do get another debasement worry, frankly.
Yeah.
And on to rates. So, hurrah! UK yield curve has shifted down across the whole curve over the past month, despite the continued political turmoil in the UK, of which more in the coming months. But that's good news. And it means actually that lower oil prices are dominating the interest rate expectations. And essentially, the markets are quite sanguine about Andy Burnham coming in. Let's see if that confidence that Andy Burnham will be fiscally prudent lasts his first few weeks in office.
And that we don't get Ed Miliband as Chancellor.
Precisely. These as US, similar story, coming down. That's great. Now, this is interesting. Although oil prices have fallen over the past couple of weeks, like month, interest rate expectations have kept on rising. That's the 2-year. So hawkish comments by Kevin Walsh mean that the market is expecting him to keep interest rates elevated in order to get US inflation back towards the 2% target. Now, we've had this whole discussion actually on the Discord. Thank you to Legion 852 and PHS in particular, talking about who's been holding gilts. Now, the green line here is UK foreign holdings of UK gilts. And I think you would say there's been a slight drift up in the past 5-10 years, but over the past 15 years, it's been fairly stable. Now, the reason we're talking about that is the OBR have released a paper talking about increased foreign holdings of gilts and what that means potentially for higher volatility in the gilts market because they're held by more fickle hands. So previously, when they were held by insurance funds and pension funds, they were long-term holders and they weren't going to come back on the market. Now they're held by foreign investors, then they can sell them. They don't have a structural need to hold gilts. They will be more fickle holders. However, so here you're looking at the salmon colored line, and you see there has been a drift up, but it's not been terribly large, frankly. And what I want to really concentrate on this chart is the orange line and the dark red line. So the orange line is Bank of England, and the dark red line is insurance and pension funds. And you'll see in the last 6 years, insurance and pension funds have started not only not buying gilts, but actively selling them. And the UK Bank of England is selling them. So that means we're lacking structural buyers in the gilt market. So who's buying them? Well, It's monetary financial institutions, which means hedge funds, building societies, investment banks, which are not structural holders of gilts, and foreigners. So, taken all in all, this shows that the OBR seems to be overstating the worries about foreign holdings of gilts, but it is true that gilts are ending up in more fickle institutions like investment banks. And any concern about the future stability of gilts could see lots of sellers and a bout of volatility in the gilts market. So this chart, you're looking at the left-hand one, and pension funds, their holdings are systematically coming down as defined benefit schemes go into drawdown and they start selling them to fund the benefits of their members. And that is structural and that won't stop. Meanwhile, this is a great chart. Look at that. Inflation break-evens in the US. Very bullish for bonds, actually. So this is UK 2-year. Frankly, I still think this is delusional. Unless we get a pickup in UK inflation, and I see little sign of that, I think the Bank of England is going to keep rates as they are, 3.75%. This is the 10-year. Hurrah! Actually down quite a lot from recent peaks. Let's see what happens when Andy Burnham gets in. Same with the 30-year. Back to almost, well, pre-war, we're approaching 5%. This is the US 10-year. German, all coming down as oil prices come down and inflation fades. Italy, Japan, even the Japanese JGB 30-year has stopped rising for now. Okay, and on to current investment themes. Well, all change. I think, interested to see what Richard thinks, that increasing signs of volatility and uncertainty. So we had the Kospi fall 10%, markets becoming concerned about extreme overvaluation, and have we had a blow off top? IPOs are about to start draining liquidity. Disruption in the war, disruption from the war in Iran. The market now thinks that is all over. I don't think that's true. The market seems to be overconfident on that front. Richard, your thoughts?
So, is the bull market in equities finally peaking? I have to say, Keith, goodness only knows.
Yeah.
I mean, by all common sense, it should be. But IPOs about to drain liquidity. Yes, disruption from Iran war. I agree that the market appears confident this can be managed. I don't share their confidence that it can be managed in a seamless manner. I think there will be some long-term impacts, but not as big as I thought they were going to be, I have to say.
Yeah.
But I also think that personally, I think that the investment thesis for fossil fuels remains intact. I bought my investments in oil prior to Trump opening the war against Iran. So nothing's changed in that regard. Monetary debasement, I don't think monetary debasement is finished. I think that's just going to...
Yeah, but for now, the market doesn't care about it. We'll uncross that when it starts caring about it again.
The market doesn't care about it. It certainly hasn't gone away. Commodity scarcity. I mean, you could argue the market is ceasing to care about that at the moment for the next few days or whatever the attention span is of the market. But yeah, I mean, that is, to my mind, geopolitical uncertainty in the end of Pax America. I mean, it hasn't gone away. That's undoubtedly true at the moment, isn't it?
Yeah, but the thing is, all these things, the market takes things too far. You've seen that Rheinmetall shares fell 20% yesterday.
Yeah.
So, market just overbid defense stocks.
Yes, I mean, I think you're right. It's been, there's been over enthusiasm. I mean, it's this sort of, everybody. It's like the ship leans one side, everybody rushes to the other side, which causes, and the whole thing is constantly.
So,
I was just going to say, sorry, I'm not being very eloquent. I think partly it's the heat, but you know, if you have nothing that has happened has changed my worldview.
Yeah, well, frankly, my attempt to like spiv around has been totally disastrous. And actually, I've just now adopting your policy in that I'm structurally bullish oil. When you look at the latest changes to long-term oil forecasts,
Yeah,
demand forecasts just keep on rising. And I really, really struggle to see where that oil is going to come from. When you're talking about oil demand reaching 125 million barrels a day, and we're currently 100 million barrels, and shale, is peaking, then I just don't get it. In 5 years' time, I fully expect the oil price to be much higher. So I haven't sold anything,
yeah.
frankly.
Likewise, and also I didn't buy anything because of the oil price spike. I already had my investments in oil, and so it was quite interesting watching them go up, and it's quite interesting watching them come back down again.
Yeah,
But it's like net, it's made no difference, I suppose.
yeah. So as last week, we are going to go do the special sections first and then do all the economic data at the end. So first of all, one chart. Now, we have talked before about how the memory chip manufacturers, their earnings are going absolutely through the roof as demand outstrips supply, leading to much higher prices. But this is old technology. All you need to do is add some more production lines, and that is exactly what they're doing. And so you are setting up for a spectacular bust. They're increasing capacity. When this surge of AI investment fades, you are going to be left with huge extra supply. Margins will not just go back to where they were previously, and previously they were de minimis. They're going to go negative because you have return supply. Demand will go back to where it was earlier, but with a bit extra for AI. But supply will have surged. That is the capital cycle. Richard, your thoughts?
I agree.
Yeah.
Yeah, basically, um, there has to be a limit to the amount of memory chips that the world can actually use, and just as there's a limit to the amount of NVIDIA chips that the world can use, certainly
Well,
the world can afford.
yeah. Well, when you're buying it with borrowed money, you know, then it can't carry on forever. So quickly on to Simon W's technical analysis.
My favourite section.
Richard, do you want to do this?
Yeah, please. So, what Simon told us this week, Micron technology, the bull market is firmly intact. I mean, so Keith and I, obviously, we're a couple of old fools who don't
You got it
understand
totally wrong.
the world. Well done, Simon, for successfully exiting your options. You must have made a decent return on them.
Yeah. So, I mean, again, we've just talked about medium term. I'm absolutely convinced Micron is toast. But it's, as we showed earlier, its earnings currently are extraordinary. And does it matter that medium term it's toast? As Simon's saying, the technicals are all bullish. And previously, he's been dead right. I've been embarrassingly wrong. So, follow the technicals, he says.
Credo as breaking out to the upside even more
Yeah,
than it was
exactly.
before.
Now, I own this on having bought it back here on the Golden Cross. Hurrah.
Oh, well done.
Yeah, well, I followed Simon and I doubled up. So, still a small position, but
Very nice. I don't own any.
so I've held my nose, Richard, and I've followed Simon. See, he seems to know what he's doing, unlike yours truly. Now, so what he's saying is this is the shorter term chart. If it can break above 303, next stop 360, except it went rather the opposite direction. But now Micron have announced these bumper results. And Nasdaq's rising again. 360 next stop. You heard it here first. All the usual disclaimers apply.
I think
Richard.
people should just buy the mining shares that I own that have done disastrously over the last few months. Come on, guys, we need some buyers.
Yeah.
So the US semiconductor index has experienced a 10%. Excuse me. Has experienced a 10% sell-off to the support line at 600, and bumper earnings from Micron should ensure that it bounces from there. Maybe, yes. The trouble with all of this is that I think the issue is if you miss the boat, sort of take this example, back in July last year, which we don't even have on the chart. From then on, it's really hard to get in because
Yeah, I totally agree.
you know it's going to get quite dangerous and you don't know where that danger point is.
Yeah, but I shall be going and putting a sell order on my Credo technology at 350 when we get off this.
Or you could put good idea. Or you could double up.
Again.
You could take your profits and put it into Credo options.
Yeah, I could, but I don't know anything about options.
So the S&P 500 has fallen to the middle of its channel. Will it hold there? Some think so. Support would be at 7,200.
Yeah. Now, what I notice is the table we showed earlier, Nasdaq up very strongly for the year, S&P 500 up only about 7.5%, which implies the average S&P stock is actually down, underperformed by a long way.
Yeah, this is true. And the Nasdaq Composite has fallen 6% gain to its 25,500 support line on concerns over AI demand, semiconductor company valuation. Oh, that's true. Next support would be 2,400. Yeah, 10% fall from the highs and a reasonable correction. But would it then fall further as the truth began to be revealed about AI demand and semiconductor valuations?
Well, in due course, I think it will. But, we'll have to get Simon to update his technical analysis when that occurs.
My challenge to Simon is to give us a point at which we should short these stocks.
Well, I'm actually tempted to short SpaceX, but every time I do that, it's total effing disaster. So I'm not going to.
I don't short, full stop. It's too difficult. It has actually fallen through 40.75. It's just fell a little bit below 39.80, I think, yesterday. So the next support is 34.80. Maybe so. I think that the gold market has a lot of future potential.
Yeah.
And
I don't disagree, Richard, but short term dynamics are really bad. Actually, when I look at that chart of Chinese whole ETF holdings of gold, that was meant to be a bullish chart, i.e., the Chinese are still buying. Actually, I took it the other way. I looked at the size of that and think they're all sitting on huge losses. When do they cut them?
Yeah, maybe. I mean, it's a trading style, isn't it? So I've determined that I have my macro view, my long-term view, and I'm not going to trade. So I don't trade. And actually, when things go down, it's not great, but it works for me. It's much better than losing a position and never regaining it and wishing I hadn't sold it.
Yeah.
So that's a psychological thing. That's what works for you as an investor.
Yeah, I mean, the thing is, I think what you have to do is hold companies that you can hold through downturns, through bad downturns. And frankly, energy, I'm concerned that when the market sells off hard, that it will go down. But medium term, in 5 years' time, I've got no doubt oil prices will be much higher than they are now.
I don't think the energy market is going to sell off hard, Keith. Personally, I think it's already sold off hard from where it was. It's only slightly above where it was at the start of the war with Iran, and I don't think it's going to sell off hard.
Yeah, well, they're paying me decent dividends.
They do, don't they? Some of them are very
Yeah,
good.
so can hold them forever.
Yeah. So silver. This is Simon's way of saying it's taking a bath, I think.
I think it is. And the thing is, this was my original prejudice. I think that this is true. So, I think, just be wary. Now, you think that, now, however, we would say on the flip side that there's a structural deficit in silver that there wasn't back in 2011, and industrial demand in the form of solar panels is going through the roof.
So I don't want to come across as a sort of conspiracy theorist, but the silver has been manipulated for decades, and you can only manipulate the price of a commodity when there's a surplus of it. Because clearly, if there's a deficit of it, you can't sell it short. And there is a deficit of silver. The exchanges are slowly being emptied of silver, and at some point, this deficit is going to. I mean, some of these big banks in the US have massive naked short silver positions that they have to get rid of before the price of silver goes up. And you should just have to, you don't know when it's going to happen or what they're going to do. You just have to stick with the thesis. And I'm sticking with the thesis. Yeah. So in some senses, you could, if you're of my mindset, you could say, well, the chart is saying this, or you could say, well, the clever psychologists at these banks, and clearly they employ psychologists when they manipulate prices, are painting the chart to look like this, and at some point it's going to change. Maybe the next floor for silver is at 50, maybe it doesn't get to 50, maybe it falls through it. But long term, it's a viable proposition for a much higher price.
Yeah, I'm betting on 35, frankly. At which point I get interested. Thank you, Simon. Usual disclaimers apply. I would remind everyone he's done much better than us over the last few years by, just following the squiggly lines. Important. And we've talked about this many times, but this week I was sent a analysis by MacroStrategy Partners talking about how AI was likely to prove a very poor investment and outlining the bear case. Now, we have covered elements of this many times, but so Nvidia makes very good profits because, in part, it reinvests in the equity of companies in its supply chain, which then buy more Nvidia products. So there's a circular economy going on. The data centers and the hyperscalers lose money buying and renting out compute. So, as we've talked about before, the hyperscalers are transforming from cash-rich, capital-light businesses to capital-heavy, cash-light businesses that need to borrow or raise equity to fund themselves. So that is a fundamental change in their business model for the worse. OpenAI and Anthropic subsidize the front-end app developers like Perplexity, Replit, and Lovable, and those companies lose money. Everyone loses money. And this is Richard's point, Richard's made this point many times, when AI is priced properly, and we're a long way from that, only then will we know what the true demand is. None of this is sustainable. So 6 reasons that the large language model AI ecosystem will fail. 1, large language models are based on correlation and probabilistic inference and will always make mistakes. And those errors will tend to compound. 3, they're hitting a scaling wall. So as the models get more complex, you only get a marginal increase in their ability as an exponential increase in their cost. Their safety and reliability problems are exceptionally hard or impossible to resolve, as Richard was talking about, trying to stop them hacking. Very easy to get around. They have no moat. That is a huge one. And helping people code, which is actually their core value proposition at the moment, is only a very small part of the economy, around 0.9% of employment in the US. True value creation involves creating a profitable commercial niche with a big moat around it so you can enjoy supernatural, supernormal profits for a long period. They don't have that. So, number one, well, symptoms that is all falling over. Do you remember the OpenAI video app called Sora? According,
Yes.
according to the BBC, Sora cost billions of dollars to run, but failed to retain users and was financially unsustainable. So the costs of developing AI video are absolutely enormous. And because errors compound, over the course of a 10-second video, you would get the AI just going off topic, and the results became increasingly incoherent. Microsoft, OpenAI, and Anthropic have, as you'll all know, switched from charging users a flat fee to charging by usage, with the result that you've had a blizzard of companies complaining that their first quarterly bills or monthly bills were much, much larger than they had been expecting. Uber and Walmart are among companies restricting employee usage of AI. The idiotic practice of token maxing, i.e., apparently some companies were ranking their employees by their usage of AI. The more AI you
Yeah.
use, the better. Well,
When you
that's
say
bad
some
news.
companies, though, Keith, companies you would have thought should know better, like Meta and Amazon.
Hmm. Actually, nothing would surprise me about Meta. Suddenly, there are real costs to AI usage. And as you'll see as we go through this, companies are scaling back. So, showed you this chart earlier. Higher costs means suddenly companies are thinking about their use of AI and they're cutting back or they're switching to cheaper models. And that is a massive problem for hyperscalers because this is their revenue forecasts or cash flow forecasts. They're expecting that they're investing loads and loads in data centers the next couple of years, and then people will spend an infinite amount on AI and their free cash flow will go through the moon. Well,
If you just go back to that, Keith, you can see there is a hockey stick. And we
there
all
is.
know that businesses that project hockey stick charts are inevitably wrong,
Hmm.
except perhaps for NVIDIA.
Yeah, well, yes, that's true. There are exceptions, Richard.
Yes.
I just can't see, we'll go through this. I can't see them all doing it. You need to have a monopoly. So, first of all, let's talk about circular funding. So, this is how it works as an example. So, NVIDIA bought its own chips using a special purpose vehicle which it owns called Valor. So, special purpose vehicles, as you'll all remember from Enron, you can keep off the balance sheet. So, they spent about 1.4 billion on that. The SPV then raised 3 times that in debt from Apollo and bought more chips. Okay, so we're now talking about 5 billion of chips. And Apollo got its in-house insurance company, Athene, to fund the majority of that debt, leaving its customers, the Athene's customers, which are annuities and insurance purchasers, holding the risk.
That's very clever.
Yeah. So why is it doing this? Well, it owns these chips and then it leases them out to customers like Grok. So what essentially Nvidia is doing is it's gearing up its balance sheet to buy chips to lease out to its customers like Grok, which then don't have to fund the purchase of those chips via equities or debt. But it means Nvidia is more geared. And do you remember like British Aerospace when it was leasing out its own aircraft? And then there was a downturn in the aerospace market, and it was essentially almost went bust.
It's a bit like And do you remember the magic circle of investment trusts that were all investing in each other's preferential shares? And so they're all keeping their shares. This was back 25 years ago. They're keeping their share prices up until it all went wrong. Then they all went bust because they all owned shares in valueless companies.
Yeah.
It's the same thing. It's vendor financing, isn't it?
Yeah.
Problem with this is that it's vendor financing to non-profitable end users.
Exactly. Yeah. As we know from the SpaceX IPO, where they had to actually declare how much money Grok's making, it ain't making money, it's losing a lot of money. So there you go. Hyperscalers, their free cash flow has collapsed as they have been investing in data centers and in buying their own chips, etc. Worse than that is not just their cash flows collapsing, they've actually been turning to bond markets. So why is the large language model ecosystem going to be fundamentally unprofitable according to MacroStrategy Partnership? Well, number one, large language models suffer from structural errors, which are going to be very difficult to eliminate because essentially they work on correlations. So LLMs have been trained on a data set that includes basically everything ever published, and they use that to produce correlation-based weights in vectors for every word in the language. So ChatGPT has an astonishing 12,440 vectors for every word in the language. So give you an idea of what this is like. So the vectors for cat and dog will be similar because they're both pets, both have four legs, both have fur, etc., etc. But a dog is more likely to run in the garden. A cat is more likely to run around the house. So if you... Sorry?
Is that true?
I don't know.
Did you get this from AI?
So if you were to type in a dog is more likely to run in the... you would probably get park or garden in from an LLM, and the cat is more likely to... The answer is likely to be room or house, etc. So when you ask a large language model a question, it uses a probability matrix to come up with the first word. And now this is really, I didn't know this, so this is really important. So it then takes that word, adds it to the question, feeds it back into itself to get the next word. Okay? That is not intelligence. It's also incredibly inefficient.
Can I just interrupt you for a moment, please? So I put in two searches into Google. First one, where is the dog most likely to run? The dog is most likely to run in wide open, stimulating environments like expansive green parks. And for cat, when a cat escapes, they rarely travel far. About 75% of lost cats are found within 500 yards of where they escaped. It's like completely random, isn't it?
There you go. Well, they weren't very good questions in the first place, Richard, but anyway. So large language models assume that the correlations they have been trained on are stable, but they may not be. For example, maybe a third-party mutual dependence. So lower crime and ice cream sales are correlated because of time. They both are lower crime and higher ice cream sales are correlated with the summer months. One does not cause the other. So therefore, if you try and use that correlation for anything and say that ice cream sales have spiked, therefore crime must come down, you're not going to get a very satisfactory result. And correlations may be spurious because of the lack of data. That's particularly true if there's not enough data to train the model correctly. So in his book, Spurious Correlations, Tyler Vigeland observes that between 2000 and 2009, there's a 94% correlation between US per capita cheese consumption and the number of US citizens that died becoming entangled in their bed sheets.
In fact, Keith, 73% of all correlations are spurious.
Well, quite right, Richard. So there you go. Eating cheese is clearly very
Let me
dangerous.
just check that with Google.
And also, when there are competing correlations, the large language model may simply pick the wrong answer because large language models do not have a concept of time. They're just as likely to provide an answer from old data as for the latest data. This is particularly true if, so for example, if somebody has used the line latest earnings season in the company's earnings for 3 years ago, and you type in please provide data from the latest earnings season, it is as likely to provide the answer from 5 years ago as it is from today. And I know that because I've experienced it. Now, also, errors compound. As I was explaining earlier, large language models work by generating the first word of the answer, then feeding that back into the model as part of the enlarged question to generate the next word, etc., etc. So, if it starts to go off track, it will exponentially go off track. And if you're attempting to, let's say, generate 1,000 lines of code with 15 tokens per line, that involves 15,000 model runs and a lot of room for error. So this is the remote labor index. And these are examples of tasks that real world people are paid for online. And it has asked AI to try and replicate and see if it can if it can do real world tasks. So, to give you an example, format a paper from the files in the bottom and produce graphs, etc., etc. Or turn a PDF of an architectural design into a 3D model of the final building. And the tasks involved were ranged from relatively simple, so ones which would take, less than an hour and cost $100 to ones which would take hundreds of hours and cost $10,000. The results were a bit piss poor, to be honest. So Opus 4.61, it completed 4.6% of the tasks to the standard where somebody would pay for them. GPT-5, 1.7%, bit shit. Scaling. So LLMs are incredibly inefficient in their computing use. As you increase the number of vectors, i.e. increase the model complexity, so you need to recalculate all the vectors for every word. So you get this exponential increase in the number of vectors and the computational complexity. And they scale like the numbers at the center of Pascal's triangle. If you increase the number of vectors, you get this massive increase in the complexity and computational difficulty of the model. And this is from ChatGPT's own internal research. So on the y-axis, you have the strength of the model, the ability of the model, according to GPT's own internal analysis of its models. And on the x-axis, you have the dollars required for training it. And you'll see that shows very rapidly diminishing returns. I don't think that's going to converge on one.
This YouTube video, once it's published, is going to become part of ChatGPT's training database, and it's going to send a robot to your front door to have a word with you about disrespecting its abilities.
If it's been passing these videos, Richard, I think it will decide that our prediction ability is 0, and therefore it'll just ignore the whole lot in bloody sense. Anyway. Safety and robustness. So large language models may be trained on bad or malignant code, i.e. if there's a Pac-Man code on the internet, that contains malware, LLMs will just use it. They don't evaluate it for safety, nor do they code efficiently. If you are writing a code which has to access the database, you would write a subroutine so you could call that subroutine to access the database. LLMs may simply rewrite that subroutine 300 times, stick it in the code. Each one may be slightly different. Try bug fixing that. And when I've got friends who've been playing around with vibe coding, this is exactly what has happened. Essentially, at some stage, they have to give up.
You just have to type in "fix this code," Keith.
Yeah, that's true, actually. Lack of a moat. Well, the mathematics of AI models are very well understood. There are few technical barriers to entry, as we know from DeepSeek. So if you build a model for 5 billion, it may take your competitors only a few months to distill it, extract its vector weights, and come up with a simpler version that costs 10% what it costs to develop and is 97% as good. You've got no moat. Why would people pay up for the newest version? Older models become commoditized and offer exponentially better cost performance payoffs than the latest models. Businesses will simply use the old models. So this is the Pareto frontier for large language models. And you see, so on the on the y-axis, you have ability. On the x-axis, and this is exponential. We've got another exponential x-axis. You'll see DeepSeek V4 Flash, that is costing about 15 cents per token, I think. Yeah, per million tokens, 15 cents, compared to, what's that? $40 for Claude Fable 5. And Claude Fable 5 is what, 5% better? I know which one I'd be using. So, Chinese AI models, that's the red line, are rapidly narrowing the gap on the US ones, admittedly with a little lag, but they're like 50 times cheaper. So, unsurprisingly, when you look at who's using what, Chinese models usage is far outstripping American models. Now, we don't have any data on where that usage is coming from, but I'd bet a lot of it's coming from the West. It makes sense. Meanwhile, there's very little evidence that the broad mass of consumers and businesses are willing to pay for AI. Essentially, all the spend is coming from the top 1% customers. You know, the average is not very much. Nobody's paying for it, basically.
$11, not.
Yeah.
No.
Lack of addressable markets, best at coding. Software developers are 0.9% of US employment.
It's good at following rules, isn't it? So I think it's good at doing legal stuff because there's a clear set of rules it can follow.
Yes, we'll get onto that actually in the UK section. Bottom line, AI companies lack a moat. That's the big one to me. They show diminishing returns to investment and the expensive new models rapidly become commoditized. I just don't see how they're going to make any money out of this. So we continue to believe this. AI is an investment bubble that will eventually pop. I know that we've been totally wrong on the share prices, but Richard, your thoughts?
I agree with everything, Keith. I think my concern about for example, SimonW's charts, and clearly he's been successful. My concern about them is that I think they're subject to pretty much a discontinuity.
Well, yeah, I agree. But the thing is, Richard, when you think about .com, the dynamics are absolutely the same.
Yeah.
At some stage, you know that pets.com can't possibly make any money, but the share price goes through the moon because you have Ponzi. The dynamics of a bubble are that you are not expecting it to last. You're expecting it to be able to sell it to some sucker at a higher price.
Yeah, so that's the problem with investing in AI, etc. Because it, he's not capable of doing the things that its proponents, who are basically very much invested financially in it being successful, it's not capable of doing what its proponents say it's capable of doing. And I suppose it has uses. There's no doubt about it. It's a very powerful tool when it's used appropriately. But someone I know who works, who receives a lot of project information. So they said to me the other day that they're fed up with getting all the AI slop.
Yeah,
it makes their life so much harder, and it's fun, isn't it? It's fun to use and gives you an answer. I mess around with Google and ask those stupid questions. Every time I ask it a question, it costs Google whatever it costs Google, and it's no value whatsoever. This is going to come out in the wash because, and when it comes out in the wash, these things will be they will be proven to be very clever, very good at some things. I think fundamentally the LLM model is a blind alley in artificial intelligence. It will prove to be an effective blind alley at what it's done, but it's not. It's never going to lead to general artificial intelligence, which is what the sort of hope is of people who've heavily invested in it. And I think that it's just a question of time, but it will not. It's not. It's like the internet, isn't it? It will become very, very useful for certain things.
Yeah, I think it'll become very, very useful for categories where there is a lot of data to train it on, and you have a relatively limited range of output options.
And you have clear rules for it to follow.
Yes, precisely. So legal, I can see it works really well on that. You have a whole database of previous cases, and every new case is just a subset of the previous cases, so it can search and come through with examples and a good predictions. But
the problem we got at the moment, Keith, is, as we alluded to, there's been so massive amount of capital investment in this. A lot of it is off balance sheet, and it requires huge cash flows in order to pay for it. Those huge cash flows actually aren't going to be forthcoming, and then
absolutely
the whole scheme, it's a Ponzi scheme. The whole thing will collapse under its own weight, and out of the collapse will emerge, like a phoenix from the ashes, will actually emerge the proper uses of it.
Well, I come back to your point about it's just not priced properly. And so if we think about Google, and now if you type in to Google, you will get first up often its AI answer.
Yeah.
And when you do that, that's probably costing what, 10 or 15 times what the just a straight answer would be.
And it's free.
And it's free, and you ain't clicking on any adverts.
No.
So isn't Google rather undermining its own search engine business? Question mark.
And also it can be very irritating because it gives you the long, complex answer to a question you didn't ask sometimes.
Well, where's the dog gone?
Because it misunderstands the question, yes.
Okay, and Richard, do you want to do this? Falling birth rates?
Yeah, falling birth rates and the rise of robotics.
Yeah, well.
Especially in China. So birth rates steeply declined over the last 15 years in high-income countries particularly, but also beginning to decline in lower-income countries.
Yeah.
And is there an acceleration from 2015? Yes, there is, isn't there? Yeah.
I mean, there is. I mean, it's these are astonishing numbers. Because you think like Catholic countries, Latin America.
Yeah. So well below the replacement rate. Middle East and North Africa, probably just about at the replacement rate. East Asia, less than 1 by the look of it.
Yeah. Totally disastrous.
Yeah, Northern Europe, around 1, maybe a little bit over 1. So neither the US nor Mexico have a replacement birth rate.
But I mean, it's amazing that this is not just a first world problem. This is everywhere. You're seeing a huge decline
Hmm.
in the birth rate.
I mean, in terms of the environment, the population of the planet, the human population of the planet needs to, at the very least, stabilize. And ideally, I would suggest it needs to fall over time in
Yeah.
order that our environmental impact is not too, it doesn't effectively destroy the ecosphere. Um, so I know that there's a lot of economists bemoaning this, but in reality, you have to ask yourself the question: is it actually a good thing for the planet?
Yeah. I agree.
So there's Japan's working age population, which is as productive as ever, but excuse me, shrinking. And of course, the issue here is that the working age population has to effectively, the ratio of working age person to elderly person who needs to be supported is falling
Yes,
all the time.
precisely.
And there's a gap between the number of children people would like to have and they can afford. It is actually that they can afford. And that's because in the West, at any rate, we have been subject to hidden inflation for
Yeah.
many decades.
Well, asset price inflation, but particularly housing inflation. But that's actually, see, that would be my prejudice, Richard. But that's not quite the story the data is telling us. Well, the data is telling us is that women ideally want to have the same number of children.
So part of the problem, or is it a symptom of the problem, is that young people are no longer finding stable partners to start a family with. And marriage rates and cohabiting rates are declining all around the world. Is this to do with social media, one wonders?
It is, yes, that is where we are going. So, what it's basically saying is that ideally women want to have the same number of children, but they're not coupling up in the way they were. They're not finding marriage partners.
So why is that with all these dating apps?
So, hang on, but answer that question in a second, Richard.
Women who become mothers of roughly the same number of children they did in previous generations. So the problem is that fewer women are having children.
Precisely. So, if they end up in a stable relationship, they want to have the same number of children. They have the same number of children. The trouble is, a growing portion of women are not having any children.
Okay, so decline in relationship formation is basically higher. The higher your level of education, the more likely you are to form a relationship. It's interesting, isn't it? And unaffordable housing explains some of the birth rate fall, but
Yeah.
it doesn't explain the most recent drop from around about 2000, mid 2000s.
Yes. So your point, there is hidden asset price inflation and the housing market does explain some of it. So young people are finding it increasingly expensive just to live. And so children are then an unaffordable luxury. But that does not explain the core of the problem.
So fewer couples means fewer children, given that couples have the
Yeah.
similar
So basically,
number.
there's a
Yeah,
very good correlation between fall in the coupling rate, as they
yeah.
indelicately put it, and the fall in fertility.
So for fertility rates in the US, Australia, and UK, having been relatively stable, seriously began their decline around about 2007. And Indonesia and Mexico, it started to fall around about 2012. Well,
Yeah,
Mexico seemed to be falling for quite a long time
yeah,
before that.
exactly. I would say that
Indonesia,
too. Yeah,
Indonesia, 2012.
yeah,
Egypt and Iran, Egypt and Senegal and Iran around about 2015. And they coincide with smartphone adoption dates in the different countries. So are we blaming, as well as everything else, are we blaming Mark Zuckerberg for this?
yeah. We are. That's right. So basically, people are spending more time on their mobile phones and becoming less social.
Is that? I mean, is this a spurious correlation?
Well, there you go. Look at it. I
Yeah.
would so I would say it's not just smartphones. It is woke ideology you're getting from smartphones and social media, and people not interacting the way they once did. The barriers to, if you're a bloke wanting to chat somebody up in the pub,
Yeah.
do you do that anymore? I don't think you do. I think you now the only place where you are socially allowed to try and chat somebody up is on the dating apps. Everything else has been banned basically by society.
Is yeah. I mean, it is, and also maybe it's something to do with the way people communicate that makes it more difficult to develop a relationship, because, as we all know, developing a relationship is complex and it has its ups and downs. And in the world of
Yes.
social media, there are people looking for instant satisfaction, instant happiness, and it doesn't arrive, so they move on to the next person. And of course, it doesn't exist. We know it doesn't exist.
Well, also, but social media pushes these ideals, don't they, in which
Yeah,
both sexes
yeah,
have increasingly different views of what constitutes an ideal relationship.
yeah. So spending more time alone on their smartphones and less time socializing.
So this is it. This is actually this is what the story they're trying to say. The people basically are socializing much less, and if you socialize much less, you meet other people much less.
Yeah, maybe. I mean, if you go out in, obviously London is a special case. If you go out into London, there doesn't appear to be any lack of socialising. Does there? The bars and clubs are always full, restaurants are full.
That's true. That is very true. But this is the number. These are the numbers.
Yeah,
The question is, Richard, when you see those people out and about in London, how many of them are young?
yeah, that's a good
So,
point. I'll do a straw poll.
yeah, because
Yeah,
when we go to restaurants, I would say they're overwhelmingly old gits like us who can actually afford to go to a restaurant in London. When I talk to my daughter about, they spend a lot more nights in, frankly. We used to be, when started work in London, we'd be out with work colleagues every night of the week getting pissed. Now, I doubt very much you can afford to get pissed every night of the week in London with a pint being £7.
yeah. It's a puzzle, though, isn't it? It's not. It's not. You can see that there is a correlation. It's not immediately apparent what the cause of that correlation is.
Well, when you look at South Korea, I mean, that is an astonishing fall.
Yeah.
It's halved in 20 years. So you're meeting fewer people and you're not forming.
Let me just chat with a friend of mine to see whether they agree. Yeah. I mean, there is definitely mental health issues as well.
Yeah. So young people, they don't smoke, they hardly drink. Instead, they have worse mental health and self-harm, etc.
I was walking.
Which is like, we should be encouraging them to smoke and drink, in my books.
I was walking past a group of people, or just a couple actually, yesterday, outside a large London hospital, and they're probably in their 20s. And one of them female said to the other, "Wait till I get this on TikTok," or something like that. And I just thought, what is the point?
Yeah.
What is the point of getting something on TikTok? What does it actually achieve?
Well, the thing is, Richard, you are the wrong audience for that question, aren't you? As am I. Perhaps if all their peers were TikTok, it means something.
Yeah, I mean, it does, but it is a utterly meaningless activity.
Yeah.
Objectively,
Okay.
it's a totally meaningless activity. And it can't possibly lead to happiness, because meaningless activities, meaningless functions lead to mental health problems, if that's all you ever have.
Really? You're going out drinking with your mates?
It's not meaningless. It's socializing. Sticking something on TikTok is meaningless.
Okay. Right.
I
Well,
mean, I'm
my
prepared to be
takeaway
challenged.
my takeaway from this chart is that we should be encouraging socializing amongst the young and more drinking. And Andy Burnham's going to need a minister for more drinking, and
He is, isn't he? Maybe,
I,
maybe a
I'm I'm
minister for
applying for the
reducing,
job.
maybe, maybe a minister for reducing employees' national insurance as well,
Yeah, well, exactly.
and a minister for reducing energy costs, and one for encouraging investment.
Yeah, well, that's true.
So social media leads to self-radicalization and widening gap in political leanings of the two sexes.
I think this is absolutely true.
So was it right-wing men?
Well, the
Explain
thing
this
is,
one. Could you just
men, men haven't become more right wing.
no?
Women have become increasingly left wing. And so the two find themselves politically further and further apart. Although you'll notice that men with degrees, they're
Have
although
become
they
more
become
left
more
wing.
left wing.
That's because the universities are hotbeds of left wing nonsense,
Yeah, that's true.
and they without proper debate.
Yeah, the thing is, Richard, we we graduated somewhere way to the left of this chart.
We had graduated in an era where we could actually, within sensible constraints, we could actually say what we felt.
Yeah. Well, or you could interpret this chart as men with a higher degree or higher are learning to adapt their politics so they can get a shag. Am I allowed to say that?
No,
Anyway,
sorry, you're going to
you
have
heard
to.
it here first.
That's all language, Keith. I'll have to
Yeah,
stop
exactly.
coming on the show.
Well, they're pragmatists.
Oh, the fresh Kincaid grade level.
Yeah,
Social media appears to be having a disastrous effect on students' reading scores. Goodness me.
this is quite a shocking chart, actually. So you basically had a 1 point drop in average reading scores between,
2015.
yeah, for 10 years.
And it's across the board.
Yeah,
So it is. I mean, I think one of the problems with social media is you get this quick fix, and I was aware of this, but not aware that it was a concept, that it was a deliberate act. That, until the other day, when I read it to do with social media, smartphone ban for children under 16 in the UK. There's this concept of infinite scrolling, where
yeah,
you can scroll forever, and it will continue to give you pictures.
yeah,
And it's a totally meaningless activity, but the human brain is always looking for that next little fix and you're waiting for it to come up. And but what it means is that you're constantly looking for a fix. And when you're reading something, you do not get a constant fix. You get satisfaction from reading the whole. You don't get a
yes.
fix every 7 words.
No, that's true.
And it's training young people's brains to expect a continuous fix of excitement.
Yeah, I was reading the book sales are falling at an average of 2% a year. And I'm
Yeah.
not at all surprised. And frankly, I just don't think that that's fixable. As you say, trying to read a brief history of time, you're not going to get, satisfaction every page.
No. I
You're
enjoyed
gonna,
reading Harry Potter, I have to say.
well, there you go. Grade 8, Harry Potter ensures your content will be read by and understood by 80% of Americans, i.e., 20% of Americans can't read Harry Potter.
Well, hang on a sec, Keith. I found it a bit tricky in parts.
Well, I take it I hope that's because you have a lot of Americans whose English is not their first language.
Possibly so, yeah.
Possibly. I wonder if we did that in the UK, what the result would be.
I mean, academic paper 16 to 8, depending on what the academic paper. If it's on sociology, I can't read it.
Yeah. I was reminded the other day of the Alan Sokal hoax paper he put into a sociology journal, social sciences journal, where he constructed this paper on why quantum mechanics was a social construct and then submitted it to a social sciences journal. And he intentionally made it all contradictory. So they couldn't turn around and say, this all makes sense. You tried to make this, this hoax, but actually you've contributed to the science. And anyway, they published it, and then 3 months later, he revealed that it was a load of nonsense. So why we teach this stuff at universities is absolutely beyond me.
And we charge students an arm and a leg for it.
Yeah,
that they have to pay back over 30 years, or 35 now, thanks to Rachel.
Yeah.
So the summary is smartphones appear to be having a profound impact on society. And young people are increasingly solitary. It's very sad, isn't it? Socialise less, spend more time on their own, have lower mental and physical well-being. We do have to also wonder whether from 2020 onwards, COVID has also been contributing to this because of the social deprivation suffered by young people in that period. Thank you, Boris. But the trouble is you can't reverse the digital revolution. Absolutely you can't. But you can try and do something about it. I'm not necessarily myself averse to a smartphone ban for under 16s.
Yeah, you can't do it, mate. It's just not going to work. People will find a way around it.
Well, maybe so, but maybe if 10% of people find a way around it, it's like 90% effective, isn't it? I don't know whether we should be looking for perfection or just something that tries to. Maybe it's complex. I grant you, Keith, it's very complex.
Well, I think you're dealing with structurally lower fertility levels unless you can deal with this. Bring back national service.
How will that help?
Well, it force everyone to mix together.
Doesn't sound like national service to me.
That's true. Okay, that's true. That is true. Okay, moving swiftly on. Actually, so implications. So a falling birth rate have profound economic implications.
I haven't got paid for national service again.
Yeah, here for the orgy.
You heard it here first. Yeah, key solution. I really am going to dissociate myself from this podcast.
So, increasing dependency ratio, lower economic growth, lower investment, lower consumption.
Being equal, aging population tends to be deflationary because it is contested, but they spend less money on buying new cars and dishwashers and washing machines. They spend a bit more money on elderly care, don't they, and similar.
Yeah. But fundamentally, don't spend any money.
No, you don't need to because you've got everything. You don't really wear it out anymore.
Yeah.
Yes, well, how do declining populations pay off huge debt burdens? Well, they can't, can they? It potentially has to be written off. And I actually genuinely think that robotics is going to provide some form of a solution to this issue. There you
go, Richard. You're way ahead of
it. That is a sort of a one-dimensional solution, but what effect robotics has on what other effects robotics has on society is unknown. And here we have Hyundai voting to strike. Now that's a bit of a knee-jerk response, perhaps, but they fear for their jobs. So I think there's a huge amount of uncertainty coming into the other problem with robots is that I think this is the AI issue. It's actually relatively simple to train a robot to perform a function. It's extraordinarily difficult to train a robot to perform generally.
Yeah, I just wonder what's going to happen when the first one of these goes mad and kills a few people.
Yeah, I read the other day that self-driving cars, because they all follow the same rules, you can get self-driving car traffic jams where they can't actually get out of it because they all have the same rule set.
Yeah, joy.
And they're not allowed to break the rules. So if you get a roundabout, a bit of a startup of a roundabout, it can be fixed because people will break the rules, and that's okay. But self-driving cars can't do that.
That's a very good point.
There's actually an article in Scientific American about it this week as well. It's to do with you need a variety of behavioural responses to a particular situation, and that variety of behavioural responses enables a group to solve the problem. Whereas if they all have the same behavioural response, they can't solve.
Yeah, you need to stick one cab in 20 needs to have the Londoner driving rules where basically do as much as you can and get away with it.
I do a bit of driving in Dorset these days. I have to say, I mean, I'm sort of driving London style, driving Dorset style, and I sort of stick out like a sore thumb, and I have to try and tone it down a bit because
Exactly.
it's just
Uh,
they're not expecting it.
Now, we're in Colorado. It's extraordinary because everyone is so polite.
Yeah,
You get to a four-way junction, there
yeah.
are no lights, and everyone stops. And I was like, whose turn is it? And actually, I spoke to a local about this. They all are checking to see who was the last person to
Whose
arrive
turn
at
is
the
it next?
junction, and it's their turn, and they kind of self-police this. Whereas, as a Londoner, you think, well, nobody's going, I'll go.
Yeah. Or I'm going to go anyway because no
Yeah,
one's going to let
exactly.
me in. So China's democratic declined. It is moving rapidly to adopting robots, substituting technology. So yeah, I mean it is inevitable, isn't it? And
Yeah, but look at that.
I mean China is the robotic hub of the world, isn't it? Another area where they will have an indomitable lead.
Yeah, an indomitable lead because when one of these goes mad and kills everyone, they can hush it up.
You're too fixated on iRobot, Keith.
Yeah, you're
The
right.
positronic brain. Are they have so the positronic brain of Isaac Asimov was artificial intelligence, wasn't it? He made it up, but it was clever.
Yeah.
We
Well,
won't get artificial intelligence until we can miniaturize the computational process into something like a brain. Can you imagine something like that size, well, much smaller than I can make with my slightly arthritic fingers now, is the size of a rat brain, and everything that a rat can do. That
yeah,
huge data center in the middle of Texas can't do 1/1000th of it. And
at a vast electricity cost,
yeah,
energy.
people say this is the road to general intelligence. Nonsense.
Yeah.
It's not. So, sorry for a slight digression there. Academic literature divided over the impact of democratic graphics on inflation. So, yeah, is it deflationary? Maybe.
Yeah. I think a lot depends, path dependency, frankly.
I think you're probably right. Yeah, I mean, people decide that they don't want to lose all their money to go to the government for inheritance tax. They'll go out and spend it.
Yeah. But reminder, I mean, I found this absolutely extraordinary. Look at that.
Yeah, real growth of household wealth since checking it, and the elderly have all the money.
Yeah. So the young get stuffed, basically.
Yeah,
Not having any kids, la-di-da.
can't afford a house. So this is China substituting robots, and they will be able to substitute L robot for L.
Yeah.
So it's R plus L, open brackets R plus L, close brackets times C times TFP.
Yeah. But C is like, you get robots by C, capital. So you go in,
No, robots become labour.
yeah, but you need to have capital to build the robots in the first
So
place.
you need capital to grow a human being.
Yeah, that's true. That is
Interesting.
very true. That's
Yeah,
very true.
a lot of capital to grow a human being.
Actually, that is a very good point, Richard. Is a robot actually cheaper than a child? I suspect it is a lot cheaper than a child. God, you mustn't say that. There are going to be no children anymore. They're just like, oh, I can just get a robot.
Business opportunity.
Yeah, exactly. So anyway,
So will capital will demand for capital rise, and hence demand for investment structurally higher. To who knows? I think we're there are. It is so complex now, isn't it?
yeah,
There are so many variables in here, and there's so many different orders that it's clearly going to have a significant effect as this sort of robotics gets incorporated into not just manufacturing but service sectors as well.
yeah. No, there was a picture in the FT of a robot behind the till at a retail store in China. And on to this week's economic data. Quick summary: UK stagflation, growth is de minimis, but inflation should be coming down. So good news, we might go back to stagnation. Hurrah! EU stagflation, again turning towards stagnation. US good, strong nominal GDP growth. Although, again, nominal GDP growth will be coming down as inflation comes down, but the US has strong real GDP growth. Okay, onto the UK, Richard.
Thank you, Keith. So UK interest rate flat, unchanged. Voted by 72 to keep it unchanged. CPI month on month, better than expected, 0.4% expected, 0.2 actual, and the year on year is actually at 2.8%, which is lower than expected.
Yeah, that's great news, actually.
And well done, Rachel.
Yeah, starving the labour market. So, wage inflation comes down. Actually, that's quite good.
So core CPI month on month, 0.3%, and year on year, 2.6%. And RPI month on month, 0.2%, and year on year, 3.1%. So all of them better than expected.
Yeah, and actually substantially better than expected. So that's great news. So you're seeing no secondary effects from the rise in oil prices.
Yeah.
Actually, Richard, can I do this?
Yes, please do, yeah.
Okay, so this is from the NIESR, and it is their future inflation forecast based on a simple dropout model. So every month, what you're doing is you're adding in either pink line 2%, grey line 3%, or the red line 5% annualized inflation. And as data points drop out, this is their imputed pathway for inflation. But if you look at the pink line here, surely by the time you get to May next year, isn't that 12 times 2%? So shouldn't that be 2%? As PHS on our Discord pointed out. Now, he did his own calculation, and this is not seasonally adjusted. So it will be slightly misleading because UK inflation numbers are seasonally adjusted, but this is what you get, and it converges on 2%. So, but bottom line is, without the seasonal adjustment, you are going to get rising inflation over the rest of the year. But obviously, we're now going to get falling oil prices. So inflation should come back down, he says.
Yeah. So PPI month on month, 0.2%. Year on year, 8.7%.
Yeah. But again, that should now go negative, strongly negative.
Yeah. And so PPI output month on month, 0.5%, and year on year, 4%. So a bit higher there.
Yeah. So implies some squeezing of margins.
Yeah. Average weekly earnings, 4.4% in April, which is above expectations and is quite high.
Yeah.
Excluding average weekly earnings, excluding bonus, year on year, 3.4%. So again, worse than expected.
Yeah. But at least the downward path is intact. Now, if you have inflation at 2% and productivity in the UK, let's be generous, let's say naught, then you need earnings growth of about 2%.
You do. The public sector is doing better than the private sector regarding earnings growth. So public sector is pale blue, which is up at the top there. And the worst actually is construction.
Yeah. Construction sector, construction wages down 0.7% year on year. So that's the private sector. It's falling demand equals lowers wages. Public sector, 5.1%.
Yeah.
Nice work if you can get it.
Talk about not controlling costs. 3-month employment change is 100,000 in April. Although we have to be careful of this because the HMRC rate is very different. UK unemployment rate, April, 4.9%. So HMRC payrolls, 2,000 in May. And it was an adjusted 53,000 negative in April.
Yeah. So in the start of the new financial year, a lot of companies let people go,
Yeah,
just less than had previously been estimated.
yeah. UK claimant count 31.2 thousand increase in May. A bit worse than expected.
Yeah,
April
but
adjusted down.
you notice rising.
Yeah, yeah, true.
So, the labour force survey seems to give a totally different
Mm.
um, picture of UK employment than does HMRC payrolls or the claimant count, both of which are hard numbers.
Yeah. UK retail sales month on month, 1.2% in May, better than expected, and year on year, 3.2%, again, better than expected. So retail holding up. Manufacturing PMI, 53 in June, basically very close to expectations, actually. Services PMI 48.7, which is a bit below expectations.
But now oil prices are coming down and there's a resolution to the war. I'd expect this to rise, frankly.
Yeah. And the composite 49.4. So it's sort of in the middle of the range it's been in for the last year. The SBR, for a change, it's worse than expected. Normally, it's so much better than expected. 23 billion in May, 23 billion in April, only 18 billion expected. So it's a lot worse than expected.
Yeah. So no matter how much Rachel Reeves has raised taxes, increase in welfare spending and the interest bill rises more. So, when are Labour going to work out that they need to start cutting the welfare bill? Don't hold your breath.
You could look at the history of this, can't you? You can see that the Tories were not saints, were they? I mean,
No.
back to 2017, it was mostly negative, although not to the extent. But then from 2020 onwards, we had that COVID spike.
Yeah.
They never regained control of it. So that's
No,
Rishi Sunak as Chancellor. And
exactly.
they never regained control of it, and they were deeply irresponsible.
Yeah. Now, and so we voted them out because they were totally useless. But sadly, people worked out very quickly that Keir Starmer wasn't up to the job.
Indeed, job postings actually flat over for this week and last week. I mean, yeah, take this what you will. UK wage growth is 4%. And the IFS has lowered its estimates of the value added for doing a degree due to higher student loan costs and lower graduate salaries. I'm basically morally indefensible, is what I call student loans, the student loan system.
True.
Which Prime Minister implemented it? Was it Tony Blair?
Okay, yeah, it was Tony Blair, yeah. But again, the gerontocracy in action, piling costs on the young so that they can fund the triple lock for old gits like us. Marvellous.
Completely wrong. AI law firm wins UK court case for the first time. This is why AI is good at law, because it can follow the rules.
Yeah. This is great, though. So this is how AI could lower costs and increase access to the UK justice system, which is all good news.
Could probably actually introduce AI to the court system, couldn't we? So that we have AI judges.
Yeah.
Because that's pretty much rules-based.
No, that's true. But, I revert to our earlier discussion on AI going off beam.
You could have AI juries as well.
Yeah. Actually, having met people on a jury, I think that might be a good idea.
UK small boat crossings appear to have peaked year-to-date 9,000. Okay,
Hurrah.
Fingers crossed.
Yeah, fingers crossed.
So there's our summary. The bottom line is, what will Andy Burnham do?
Yeah, exactly. Deep sigh. We will cover it in due course.
Deep sigh, yes.
And onto the EU. So UK wage growth, so EU wage growth was 3.4%, which was higher than expected, and a bit too high for the ECB's 2% target. Industrial production was an anemic 0.3% year on year. EU industry struggling with competition from China and high energy prices. Construction output much better than expected, but still 0.9% year on year, hardly scintillating. Manufacturing PMI was stable and much better than it has been over the past 3 years on average at 51.3. Services 48.9, not great, but improving. Expect that to rise in July. Composite at 49.5, but again, expect that to bounce in July as the end of the war gives everyone a boost through lower energy prices. ZE Dummy Economic Sentiment Index rose sharply in June as oil prices fell. So economists expect the EU economy to do better. Consumer confidence still minus 17.7, better than expected, but still very poor. German Indeed job postings going nowhere. Wage growth bounced a bit to 3.1%. France, job postings continuing to gently fall. And wage growth very poor, 1.2%. This is a really interesting chart. Pause and have a look. This is real wage growth in various countries. And you'll see that Spain, Italy, and Japan have had pretty much no wage growth in 30 years. The Eurozone has been a disaster for the countries of Southern Europe. It's imposed fiscal discipline on them, or a certain amount of fiscal discipline on them. So in summary, stagflation turning back to stagnation. Now, thank you to SimonW for this, but from January 2027, the UK's new methane directives come into effect, and that will impose on energy importers to the EU new rules which require third-party verification of methane emissions, methane leak detection standards and remediation within 30 days, and a ban on routine methane venting and flaring. And the countries where the export and the exporting countries have to meet these requirements, or they can be fined up to 20% of their annual turnover, which is enormous. Not profits, turnover. So US, Qatar, Algeria and Nigeria have all signed a letter to the EU stating that they will be unable to comply with the regulations on the current timetable and have warned the EU that they will simply not supply them starting in 2027 unless the rules change. So, bottom line, expect the EU to back down. The suppliers have the power in this situation. The EU needs the methane gas. And onto the US. So these are interest rates, as we've discussed earlier, held at 3.75%. But Kevin Walsh has come in and he is hawkish. So the market is now expecting interest rates to rise from here and to stabilize about 3.5% long term. We will see. If the equity markets turn down, I expect that all to change. We had the final Q1 GDP estimate, and that came in at a better 2.1% annualized. Decent. This morning we had PCE inflation for May, and that was better than expected, but still 0.4% month on month, 4.1% year on year, worse than the UK. Hurrah. Core was 0.3% month on month and 3.4% annualized. Personal income in May was, again, a really strong 0.7%. Personal spending was also 0.7%. So the US consumer is doing absolutely fine. More evidence of that. Retail sales in May were 0.9% month on month, 6.9% year on year, red hot. The US economy seems to be doing absolutely fine. Industrial production in May, 1.7% year on year. Not great, but then at least the US manufacturing sector seems to be stable. Michigan consumer sentiment, not great. Towards its all-time lows. Manufacturing PMI strengthening. Services PMI stabilizing above 50. So the composite also stabilizing above 50. US economy doing okay. Higher interest rates mean that the construction industry in the US is struggling, so building permits kind of flat at 1.4 million. Housing starts fell to 1.2 million in May. That's way below expectations and actually the lowest since COVID. But now oil prices have started to fall again. Maybe there'll be a bit of an uplift in the coming month. Existing home sales, not great. Again, higher interest rates are very bad for moving house and having to remortgage. Initial jobless claims going nowhere, kind of flat. Continuing jobless claims rising from their lows. The job posting index going nowhere. Wage growth 2.4%, perfectly compatible with the 2% target. In fact, better than necessary given very good US productivity. So that is actually deflationary. Dallas Fed, so onto the nowcast, Dallas Fed 3.1, Atlanta Fed 3.0, New York Fed 2.7, St. Louis Fed 1.4. So US GDP growth seems absolutely fine. US economy ticking along. Now, the Lantern Daily Index has taken a bit of a dive in recent days, but remember, this is nominal GDP growth. And as oil prices come down and inflation expectations come down, you can have the Lantern Daily Index coming down because inflation is coming down. The US economy seems to be doing just fine. Trueflation, perfectly stable, showing no signs of pickup inflation. Now, we reported earlier the University of Michigan Consumer Survey, and this chart shows that, frankly, it's become a very unreliable guide to consumer behavior since COVID. So you'll see that the bright red line is the Michigan index, which is pretty much at all-time lows, but its correlation with consumer spending, which, as we know, has been absolutely fine, has totally broken down. Should we continue to discuss it? Question mark. Not sure. Meanwhile, further evidence that despite very strong consumer spending, the average American is struggling to make ends meet. So 6%, the number drawing money out of their pension funds to meet day-to-day expenses hit a new high in 2025. And we talked earlier about house builders. House builders ain't doing so well. So the yellow line is buildings permitted but not started, and they have hit a new high. Under construction is pretty decent, but look at the number of completed homes, very low. So the construction industry is being supported by AI data center investment. The actual housing sector ain't doing so well. US summary, US economy is doing just fine, and lower interest rates, and the end of the war in Iran and lower oil prices should give it a lift. It is being supported by huge AI investment. Quickly onto other economic charts. So this is Chinese car makers' share of the European market. It's shot up. So it's now almost 10% of the European market. And for hybrids, it's over 20%. That is bad for one of Europe's few remaining export industries, the car industry. And when you look at BMW, it's just reported a profit drop of 60%, and its EBIT margin, which used to be a solid 10 to 15%, is now 1 to 3%. Competition from China is undermining the profitability of European car makers. Not a good investment. But all this, the Chinese manufacturers are supported by the state, and it's not clear that Chinese car makers are profitable. Chinese solar panel makers are very loss-making. They have lost money for the last 9 quarters in a row. They've got excess capacity, and they are exporting that excess capacity in lower priced panels throughout the world. How long can that last? Well, the reality is, as long as you have state support, it can last a very long time. But that is undermining the profitability of manufacturing industries all around the world. Now, we reported earlier how the Hang Seng's doing badly. Well, So Chinese real estate index, which we reported on back in 2020 and how ridiculous it was, well, it's totally collapsed. The real estate index, which is the share prices of Chinese real estate companies, down 85% from its peak. When a bubble bursts, get out. The readjustments can take a long time and involve much lower prices. We talked previously about the profitability of AI companies. Well, JP Morgan think AI could lead to a surge in productivity throughout the economy. If that's true, then perhaps AI will pay its way. But what we've seen from token consumption, token expenditure, is it's down, which suggests companies are skeptical that they're getting value for money out of AI. And on to good news. And actually, I think they thought this was great news. This is from the UK. And as you will all know, the UK has a problem with water quality. As well as raw sewage being pumped into our rivers, we also have agricultural runoff in the form of phosphorus and nitrogen fertilizers. Now, it turns out mushrooms are really good at filtering this out. So the picture shows turkey tail mushrooms. All you do is you put a weighted bag of wood chips impregnated with turkey tail mushroom spores at the bottom of a river, and the mushroom grows and they filter out loads of bad stuff. 80% of the E. coli, 83% of the phosphorus, and 35% of the nitrogen. So DEFRA, Department of the Environment, is giving Anglian Water more money to upgrade this experiment. But there you go, a simple, natural way of filtering the water and increasing the water quality in the UK. Hurrah! Okay, concluding comments. Well, the market thinks the Iran war is over and the oil market will rapidly return to normal. Not so sure. Iran believes it's won and is maneuvering to impose its own control over the Straits after the 60-day ceasefire period is over. Trump, meanwhile, is an increasingly weak negotiating position. The Senate has passed a bill which would restrict his ability to restart war with Iran. He can override it, but we know he doesn't want to restart this war. So expect Iran to test how much it can get away with, bottom line. Meanwhile, the market is showing increasing signs of concern over high AI valuations, but earnings are very strong. Can it continue for a while? Almost certainly yes, but at some stage, for all the reasons we've covered, we're expecting the AI bubble to go pop. And some stage, I think the time is now, as I've said before, it would be good to start taking some money off the table and keep some powder dry. And in the UK, return to political crisis. Andy Burnham expected to become the new Prime Minister. What will he do? The market is giving him the benefit of the doubt. The gilts market has been remarkably well behaved. Just one stock I want to talk about this week. This is Pharos Energy, which I own. It has accepted an all-cash takeover offer at 28p. 42% of shareholders have accepted. Why is the share price then at 25p? Don't get it. If you know, please write in. Okay, so Richard's had to go because he's actually on holiday. So I'm again on holiday next week. Hurrah! But I will be on my laptop and hopefully on the Discord a bit more. We will do this again in 2 weeks. Stay safe, everyone. Try and negotiate the super hot weather. Did warn you about El Nino. And also these incredibly volatile markets. In the meantime, please can you press like and subscribe to the channel. And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only
and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.